People think financial power lives in New York, London, or Beijing. That assumption is outdated. Because there's a country with fewer than 350,000 citizens quietly deploying nearly $500 billion across the global financial system. And it isn't the US, China, or the EU. It controls one of the largest sovereign wealth funds on Earth. It dominates global LNG supply. And it owns strategic stakes in banks, airports, real estate, and critical infrastructure across Europe and beyond. Per capita, no nation converts energy into financial power more efficiently. The IMF has been blunt about this. Long-term influence is not determined by GDP size. It's determined by who controls capital and how patiently they deploy it. And this country understood that earlier than almost anyone. This isn't a story about oil wealth. It's a story about engineering power from cash flow, discipline, and timing. While the world wasn't paying attention, Qatar's rise as a financial force begins with a geological accident. And more importantly, with the choices that followed. The country sits atop the North Field, the largest natural gas field in the world, shared with Iran. Many nations have stumbled into resource wealth. Qatar did something different. Instead of treating gas revenues as a temporary windfall, it locked in long-duration LNG contracts with Asia and Europe, creating predictable dollar cash flows stretching decades into the future. By the 2010s, Qatar accounted for around 20% of global LNG exports, a level of dominance unmatched in any other energy market. That predictability was everything. As Fadi Bayral, executive director of the International Energy Agency, has repeatedly emphasized, long-term gas contracts create revenue certainty that allows governments to plan across generations, not election cycles. Qatar built its entire financial architecture around that single insight. In 2005, the state formalized this strategy by creating the Qatar Investment Authority. Its mandate was precise: convert finite energy wealth into permanent financial power. Today, QIA's assets are estimated at $475 to $500 billion, placing it among the world's largest sovereign wealth funds, and the largest per capita by a wide margin. The IMF has repeatedly noted that Qatar's fiscal framework deliberately separates state spending from income volatility, insulating the economy from the boom-bust cycles that have destabilized other resource exporters. Instead of overheating the domestic economy, excess capital was methodically exported into global financial markets. Just as critical was governance, Qatar avoided the trap that crippled many resource-rich states: political fragmentation. Decision-making remained centralized, insulated from short-term populism, and aligned with a multi-decade horizon. As World Bank economists have observed in comparative studies of Gulf sovereign funds, Qatar's advantage was never higher revenue. It was discipline, continuity, and restraint. By the time global markets recognized what was happening, the foundation was already complete. Stable energy income, institutional capital, and a state investor designed to think in decades, not quarters. At that point, the outcome was no longer speculative. It was structural. When the global financial system collapsed in 2008, most countries scrambled to defend themselves. Qatar went on offense. While Western banks were desperate for liquidity, the Qatar Investment Authority sat on cash, unlevered and unconstrained by quarterly pressure. That timing transformed Qatar's role in global finance permanently. In late 2008, QIA and related Qatari entities injected billions of dollars into Barclays, helping the bank avoid a full government bailout. UK regulators privately acknowledged that without Gulf capital, parts of the British banking system would have faced deeper nationalization. This pattern repeated across Europe. Qatar took strategic stakes in Credit Suisse, Volkswagen, and Deutsche Bank-linked assets, not as speculative trades, but as long-duration positions in systemically important institutions. Financial historian Neil Ferguson observed that the post-crisis era marked a shift where capital-rich states, not Western treasuries, increasingly stabilized global finance. Qatar was a leading example. The strategy extended beyond banks. Through QIA's real estate arm, Qatar acquired control of Canary Wharf. It took stakes in Heathrow Airport and landmark properties across Paris and New York. These were not prestige purchases. Airports, financial districts, and logistics hubs sit at the center of economic activity and regulatory attention. Ownership creates influence, quietly. According to OECD analyses on sovereign investors, foreign capital targeting infrastructure and financial plumbing wields disproportionate leverage compared to portfolio equity flows. Qatar understood this early. It avoided high-visibility tech hype and accumulated assets governments cannot afford to see destabilized. Even in sports and media, most visibly through Paris Saint-Germain, these investments functioned as access points into political and corporate networks, especially in Europe. Former European central bank officials acknowledged that Gulf sovereign funds became embedded stakeholders in the continent's economic stability during the 2010s. What made Qatar different from other capital exporters was restraint. It rarely chased control, avoided public confrontation, and almost never threatened exit. That made its money welcome, even during periods of political tension. By the mid-2010s, Qatar was no longer just investing abroad. It had positioned itself as a financial backstop, a role traditionally held by the world's largest states. And it did so silently. Its influence felt long before its name appeared in headlines. Qatar's financial influence was already locked in long before the world noticed, and it wasn't about size. It was about structure. Unlike most sovereign investors, the Qatar Investment Authority operates with an unusually long mandate and minimal political interference. No quarterly earnings calls. No public performance benchmarks. No domestic pressure to monetize assets during downturns. According to the Bank for International Settlements, this insulation allows certain state funds to act countercyclically, buying when others are forced to sell. Qatar is one of the few that consistently does. Compare this with Norway. Its fund is larger in absolute terms but constrained by ethical rules, transparency mandates, and domestic political oversight. Saudi Arabia's Public Investment Fund, by contrast, focuses heavily on domestic development, limiting flexibility abroad. UAE funds are spread across Emirates, diffusing centralized control. Qatar's edge is not size. It is coherence. Former IMF chief economist Olivier Blanchard has argued that sovereign wealth succeeds when it is boring, patient, and shielded from political cycles. That description fits Qatar almost perfectly. Investment decisions are centralized. Horizons span decades, and capital deployment aligns with state strategy rather than public sentiment. This model explains Qatar's resilience under pressure. During the 2017 to 2021 regional blockade, Qatar did not liquidate foreign assets to defend its currency or economy. Instead, it relied on LNG cash flows and existing overseas investments, while continuing to deploy capital internationally. IMF assessments at the time noted that Qatar's external balance sheet strength sharply reduced its vulnerability to financial coercion. Most countries cannot copy this. They lack the combination of predictable export income, political continuity, and institutional patience. Capital without discipline becomes consumption. Cash without patience becomes austerity. Qatar had both, at exactly the right time. That is why its influence feels disproportionate. Financial power today is not about loud dominance or headline GDP rankings. It is about who provides liquidity when it is scarce, stability when markets fracture, and capital when governments hesitate. Qatar understood this early, and built a system designed to exploit power silently, while the world focused elsewhere.